Hey guys, and welcome to another video. Today I want to speak about at which price Alibaba could be an interesting investment. So first let me briefly summarize Alibaba stock. Alibaba, you could say, is the Chinese Amazon. It's a business specialized in transportation and logistics, like Amazon does, and it owns other corporations like Alipay, AliExpress, and also some cloud corporations, and I think some Chinese supermarkets. So now let's get to the chart. You can see the chart looks a bit scary because it has gone down so much. From $300 it has gone down to 93 and even lower. But don't be intimidated by that. We will go to the numbers and you will see that it is a nice investment at the current price. So first I want to tell you something you have to be careful about when looking at Alibaba, and that's the net margin. Because Alibaba has a higher net margin than Amazon, far higher net margin than Amazon. It has a margin of 14-15% in comparison to Amazon's 2% net margin. You could say Amazon is just not making money like Alibaba, but Alibaba's profit margin could also decline to 2%, which you would need to be careful about, even though I don't think it will. And it's a Chinese company, so you have to be careful about the next few years if, for example, the US doesn't transport any chips to China. This could impact their cloud business and so on. So be careful about that, and it could lead to lower price to earnings ratios, which you don't really have to care that much about in the long term, but let's say it could go lower from here. But it also could go higher. From the chart, from looking at the chart, it's in an uptrend right now, but be careful about that and have it in mind. So let's start with revenue. Revenue has gone up a lot in the last few years, which is something we want to see. It makes money and its net income is also going up. Its shares are going down a bit, have gone up but are going down right now, which you want to see because it's undervalued. And it has a low PE, so you want them to buy back shares. And you want them to increase your ownership of the company. No dividends, I think. Let's look at cash flow. It has growing free cash flow and growing cash flow from operations. And the balance sheet total debt seems like it has some money left. It has more cash than debt, so it has $52,000 on their bank accounts. That's a good thing. And it has total debt of $28 billion and income of $10 billion, so it doesn't have too much debt. Now let's look at the price to earnings. 20 price to earnings doesn't seem that high, and price to free cash flow is even lower with 7 at the moment, which is really good. And cash flow is, I think, even higher than than net income. 10 billion net income and 24 billion free cash flow. That's something really nice. Dividends, no dividends. Okay, let's go on and let's put in the numbers. So first we need the revenue, which is at 126 billion. Then revenue growth, let's put in 5%. Profit margin would be around let's put in 10% or 8% for the lowest case. 8%. Price to earnings 20 or 15 first. Okay, and in this case it would be a nice price at 27, which is lower, but these are very low assumptions. yeah, the revenue is the lowest one. We can put this up to 8%. That's more reasonable. And now let's get to the profit margin, which we could put at 10%, which is a bit higher. Still not giving us a nice price right now. And if we put some higher assumptions, price to earnings of 20 and profit margin of 15%, we get our current price of $91, around that area. So 15% profit margin would be the profit margin right now, and price to earnings ratio, you could argue for 20 price to earnings ratio, which would be the lowest in this case, even though for Alibaba I would rather go with 15. So it won't be the best investment, maybe you won't make 15% per year, but you can still in 10 years 2.5 times your investments at the current price with these assumptions. And you could argue for a higher net margin, but I would be careful, like I told you, to put such high margins like 27% or something like that. And this doesn't account share buybacks and so on. So let's get to the second valuation model. In this case, investment bankers assume 1.4% growth for free cash flow, which is low, but we put it in. Cash flow 15 times. Free cash flow is 24 billion. 4 billion. Stock-based compensation isn't something we can look at, I think, but let me see. Yes, it is. Okay, 30 billion. That's a bit strange. Okay, if we can't really put 30 billion in. I'm not sure if this number is right, but I think it's something is wrong with this number because it can't be that high. Let's put in 1/5 of 24 billion, which is something I've seen with a lot of companies. Let's put in 5 billion. Net cash, net debt is 52 billion in cash. And shares outstanding 2.4 billion. Which would make it undervalued. I don't really know what the stock-based compensation of 30 is about, because if we put it in, it will be, of course, undervalued, overvalued by a lot, because they would pay out more stock-based compensation than they make free cash flow per year, which would lead to negative free cash flow. But I'm not sure if these numbers are correct or if they will stay that way in the future. I don't think so. But be careful, it's a Chinese company, so you don't really know, but it's so big that I don't really think it will do financial fraud or something like that. In this case, you can see even with a growth rate of 1%, it's still undervalued. It's put in 10 billion is more like it. 10 billion, but even with a growth rate of 1%, it would still have an intrinsic value per share of $92 with these low assumptions. So with if you prefer the cash flow valuation model, you should definitely look at Alibaba, because if we put in a higher growth rate like 5%, which would make cash flow go up to 19 billion without stock-based compensation, so 30 billion around that, it would be overvalued, or it would be undervalued. 10 billion, 35 billion is more reasonable, maybe that could happen, yeah. So these could also be assumptions we could make. In this case, it would be undervalued, and it would have a margin of safety of almost 30%, so you could argue for a stock price, or you could argue to buy it under $132 and it's currently at 93. So if you like the cash flow calculation model and you think that the stock-based compensation, there's something wrong with the stock-based compensation, go look at it. And in this case, Alibaba would be a very good investment because it is the highest I've seen until now. And I have bought it at $80, but I recommend you to buy it at the current price when you want to buy it, because I don't think it will really go lower, because I think it's in an uptrend, and if markets don't crash, and even if they crash, probably they won't affect Chinese markets too much because they have already gone down so much, but it could still happen. You could buy it at the current price or sell options or something like that. So I have bought it at around 80. It's gone up a bit from there, but at 93 it's still a good investment to be made. Maybe not to make 15% per year, but 12% or better, and with low assumptions. If the price to earnings goes up to like 40 or something like that, you would make a big, you could sell for a much higher price than this. But don't really sell your stocks, just hold them if you like the company, because in almost every case you would make more money just holding the company, because it would go up from there, from where you would have sold the company. So that's my evaluation of Alibaba. If you like the stock and want to buy it, you can do some research on it, look into the financials of the company. And if you like the video, give it a like, and bye.